Hello, I'm Jason Donovan, founder of the Wealth Titans, and today we are going to be talking about how to profit from stock market bubbles. Now, market bubbles are by far the most dangerous times for investors because prices and emotions tend to get out of hand. So we're going to look at an example of what a bubble looks like so we can avoid making costly mistakes and actually profit when the majority of investors are losing their shirts. The first step to this is to understand that market bubbles are always preceded by bull markets. And a bull market is characterized by a general rise in prices with the expectation that current growth will continue and increase. And this concept can also be applied to individual stocks. So for instance, if an investor believes that the price of a stock will continue to rise, they will say that they are bullish to signify they believe the price still has room to grow. So how can we tell if market sentiment is bullish? Here are two signs. First, investor sentiment is confident and upbeat, while analysts' expectations are highly optimistic. Second, in the beginning, the increases in market prices tend to be correlated to strong corporate earnings or strong economic data. But prices will continue to rise on assumptions of continued growth, even if no facts support the assumptions. So as prices continue to rise, a bull market will eventually turn into a market bubble, where prices begin to rise at an accelerated rate. So let's look at a classical example of what a bull market looks like and some of the pitfalls many investors fall into. In 1711, the British government created the South Sea Trading Company in an effort to cope with the massive amounts of government debt that had piled up during their years of war. Now, current bondholders of government debt were offered a chance to cash in their bonds for ownership of this new company. And the lure to new investors? The company was given exclusive trading rights to all of Britain's South American colonies. Investors, including famed physicist Isaac Newton, lined up in droves to get a piece of the action. Investors believed that armed with exclusive trading rights, the company was bound to be a success. The problem was the company itself was brand new, never made a profit, and was run by people who knew nothing about shipping cargo halfway around the world. And just like a modern-day WorldCom or Enron, the company's stock eventually came crashing down to the ground because there were no profits. Now, the story of Isaac Newton and the South Sea Trading Company illustrates a trap that almost all investors fall into. Seeing the prospects for growth and possible riches, Newton invests a little bit in the new unproven company. In our portfolios, this would represent no more than 2 to 3% of our total holdings. The price rises significantly over a short period of time, and Newton sees an opportunity to cash in with a nice profit. Now, this would be considered an excellent trade. The problem is that he didn't stop there. He began to second guess himself. As his friends and other investors got richer and richer, he began to believe that he'd made a mistake selling too early. Losing confidence in his own cognitive abilities, which if you think about it is pretty silly considering he's one of the greatest mathematicians and physicists in history, he jumps back into the market. A decision that he would ultimately regret because the market, like all bull markets, ended in disaster. The story of Newton reminds us that when it comes to the market, there is no such thing as wisdom of the masses. There's only madness of the masses. It also illustrates that even a genius can be sucked into the craziness of market bubbles. During these times of economic bubbles, there are few people who are lucky to get out at the top when the bubble bursts. But for every one individual who manages to do so, there are 1,000 Newtons who didn't. So how do we ensure that we don't fall prey to market madness and lose a fortune like Newton did? The short answer, we run, because bull markets always turn into bubbles, and these extreme bubbles always end badly. And bull markets are always followed by a bear market. And to use a more recent example, in the aftermath of 2008, the market plummeted just like the stock of the South Sea Trading Company. And this plummeting of prices is what is called a bear market, and it's where successful investors make their move. And since market bubbles always end in disaster, as an investor, we need to steer clear of the stock market when prices get out of control. This is because the bubbles themselves aren't going to make you or I any money in the long run, nor does attempting to time the top so we can get out at the exact right time. It is in the aftermath of the mayhem of the bubble that we can profit big. Post-bubble periods are by far the greatest opportunity to purchase stocks by the truckload dirt cheap. Thank you for watching. I hope you found this informative and actionable. If you have any questions, please let me know in the comments section below, and don't forget to hit the subscribe button and check out some of our other videos. To your investment success.